Good morning, everyone. Welcome to the Time Summit. This is the fourth year Bridge Alternatives has hosted the summit, and each year we try to create an event that is timely, thought-provoking, and challenging. And I think this year's content that Ryan Duncan, Brian Walls, and Chris Kennedy have put together does all the things that you will see over the next 2 days. First, a quick update on Bridge Alternatives. We celebrated our 3-year anniversary late last year and currently have offices in Chicago, New York, and Geneva, Switzerland. We recently expanded our team, as many of you have noticed, with the hiring of Molly Dietzick in our Chicago office. We've also continued to build out our counterparties, who, as many of you know, are Wells Fargo, EDF Man, Royal Bank of Canada, and a recent addition of ADM, which now gives us an outlet for FX Prime brokerage. If anyone has any questions regarding our clearing capabilities, please feel free to talk to the team members. Now a brief tour of the space we'll be using over the next 2 days. The one-on-one meetings will take place just down the hallway or the other side of this wall. All the managers and sponsors have private booths, and I've arranged them in alphabetical order. Do keep in mind the scheduling app is still open, and you can schedule meetings as you meet people during the course of this event. There are directions that will be occasionally up on the screen here. Lunch will be served out in the hallway just outside. If you have any meetings during lunch, feel free to bring food into the one-on-one space. We will have people kind of circling, picking up plates, so it's not going to get all messy. Tonight's cocktails and dinner will be here in this room and right outside. Directly after dinner, we'll be having a special guest speaker, Jaron Lanier, who will be giving a presentation of the dawn of the new everything. I hope everybody will be able to join us. Lastly, thanks to this year's returning sponsors, Chicago Mercantile Exchange, EDF, HedgeFax, and Barclay Hedge, and to our new sponsors, Dynamic Capital, Coinbase, BitGo, ProofSuite, and OmniX. And a special thank you to our strategic partner, Wells Fargo, who has graciously supported this event over the years, and to Alistair McBarnett, Managing Director of Wells Fargo, who's going to help us open the summit.
Thank you, Keith. Good morning, everyone. Some of you I know, and some obviously I don't. For those who don't know me, my name is Alistair McBarnett. I'm the head of clearing sales within Wells Fargo's FCM, and I also run the execution business. So as clearing sales head, I face off to hedge funds, CTAs, asset managers, and the investors into that space. And as execution head, we run both the voice services and the electronic execution services for the business. And from my team here today, I have John Hyde from the clearing sales team, and I have Steve Chivers from my electronic execution team. This is our 4th year sponsoring the conference, and our partners at Bridge Alternatives asked me to make a few comments. They actually asked my boss to make a few comments, and then he ditched, and then he asked me to make a few comments on the conference and why Wells participates in this. And I thought I'd do that by asking and answering 2 questions myself. The first question was, why be involved with a conference like this? And the answer sort of, for me, was kind of more related to, you look at the current market conditions. You look at a rising rate environment for the first time in a decade. You look at political uncertainty in the world. You look at the rise of cryptocurrencies replacing fiat currencies. There is a lot of change. And to understand change, you need tools. And one of the best tools we could think of is education. And so Bridge and their partners do a very good job of educating in our space. So Wells Fargo is very comfortable and very proactive in sponsoring events like this because we feel it helps make our industry better. Then the second question we always run into is, why does Wells Fargo like hedge funds and CTAs? If you think of Wells Fargo with a big retail bank who also has a markets division. And I thought a few stats would probably sort of help solidify that. If you think of our wealth channel, we have 2.1 trillion in customer assets sitting in our wealth channel. Our customers in that wealth channel allocate to alternative investments. We have billions of dollars of our customers' assets allocated into alternative investments, some of which with people in this room. We ourselves, as an FCM, have 480 customers and about 11 billion in assets, of which quite a large proportion is from hedge funds and CTAs. You're an important customer base for Wells Fargo, and you're an important customer base for us as an FCM in the space. So the reason we're involved with hedge funds and CTAs is because you're important clients of Wells Fargo, and we want to continue to grow our business and your businesses together. So with that, I will hand you back to Chris, who I think is moderating the first session. Thank you.
Good morning, everyone. So today's session concerns innovation. And I think this is a fascinating topic. It's something we've had a ton of fun with here at Bridge. But the word innovation, I think, is it's a word that I think is so commonly associated with like Silicon Valley, right? When I think of innovation, I think of Elon Musk and Steve Jobs and these, going to Mars, these big visions of the future, right? And I don't hear those kinds of things coming from the hedge fund space these days, and I kind of was wondering why, right? I think one of the reasons is we don't want to do this. I think clearly there's some long-term visions there that didn't come true. And I think in the hedge fund space, we're very careful predictors. And it's just what we do as a trade. And I think it affects really the way that we picture the future. But I think there's still something worth doing here, right? I think talking about innovation and thinking in these long-term grandiose visions helps answer this question of, what's next, right? And I think now, maybe more than ever in the hedge fund business, we want to start answering questions about what's next. So today for us, we really want to unpack innovation in something that looks a little bit like this, right? I think innovation can be thought of along these dimensions. Alpha, certainly, kind of the incentive for innovation. We want to touch on talent and technology, certainly mediums of innovation. Competition, right? This is the context of the innovation that we're doing. It's why we're innovating. We're thinking about our competition. And then also secular change, right? This is the results of innovation too. And today, what you're looking at here in this chart is liquidations and launches in the hedge fund space. And so again, I think when I look at this chart, I very quickly think, what's next? You clearly have a different environment today than we've ever had. And I think innovation is, again, kind of the medium for which we can start telling the stories that give investors, participants in the space, an idea of maybe what is on the forefront, right? If you think about a venture capitalist, they can tell you their view 10 years out on whatever industry they think is useful. I just don't think we talk about those kind of things as much in this corner of the world. So to help us with this, we've invited two completely different firms to kind of act as little case studies for us, right? To broaden our horizons, take this predominantly systematic managed futures crowd, and start to think about what's going on in all corners of the investment landscape. The first is Christina Keys. She runs Domeyard Capital. Domeyard is an investable HFT firm. And Rishi Ganti runs Orthogon Partners, which is a private assets firm. These two groups operate on completely different ends of the liquidity spectrum. Christina typically looks for the world's most liquid markets, and Rishi seeks to avoid markets altogether. He'll explain what that means later. But I think even though their investment universes are extremely different, I think these groups are both trying to really answer what's next in their own individual ways. And again, I think they provide excellent case studies for unpacking what we're doing along those different dimensions. So with that, I'd love to welcome Christina up.
Awesome. Thank you, Chris, for the introduction. That was really nice. So basically, it's a privilege to be here, and I'm happy to start off this session by giving you guys an update on kind of the trends and basically what's happening in the high-frequency trading space. I know that not all of you guys are allowed to even allocate into HFT or even to quant for that matter, but I think it's interesting. It's an interesting learning experience to kind of understand kind of what's happening in our corner here and what's actually going on, because you hear all kinds of articles and things coming out like saying stuff like HFT is dead. So I'll talk about that as well and talk about kind of what's going on from a practitioner standpoint. So let's go on here. So first, a quick disclaimer: don't buy and sell stuff based on what I'm saying. And if you lose money, it's not my fault. That's basically what this says. So We are not trying to sell you anything. So as a brief, I'll start off with a brief introduction first, and then I'll talk about the current HFT environment, what is actually happening to all these companies, why is everyone merging? Talk about the evolving talent pool, because that's the future generation of the workforce in our space. And then also talk about the effect that the articles and the news has on high-frequency trading startups like us. And then also talk about any other insights that we might have. So I'm going to keep this introduction very brief. I'm Christina Chi. I think you can probably just either look us up or you can add me on LinkedIn if you'd like. I started Domeyard out of a dorm room in college about 6 years ago now, I think. And I graduated about 5 years ago, and then since then, I've been working at the same company since then, basically, and we decided, from the very beginning, let's focus on high-frequency trading, and let's do a hedge fund structure from the onset. And so those are some, two kind of, when they kind of don't really belong. But we did that anyway, and ended up, becoming, one of the fastest-growing HFT firms out there over the last couple of years or so. So we've been very fortunate to still be alive today and to be up and running as a team. We're located in Boston. The average age, I believe, is now 37 on the team. People always think that we're, a bunch of kids running a fund, but in reality, we do have some gray hairs on the team as well. Investors are mainly family offices and high net worth individuals because we're a capacity constrained fund. And we have some great, some great people on the team. So for me, the biggest privilege has always been to work with a group of very smart people who are much smarter than myself on the team. So I'm going to move on to the next slide. I think the best way to kind of show what we do is through photos as well. So lots of photos included here, but we're very tech intensive. We're in Boston, but our servers, that we trade from, they are co-located in Secaucus, in Aurora, and all the different, where all the servers are supposed to be. So anyway, let's move on here. So a lot of our investors will come up to us and they'll show us these articles about HFT. Some of you have probably already read them about, high frequency trading is dead, it's gone. Someone wrote about, there's what's happening to the flash boys, are they going to go away? Virtu acquired KCG, right? And those two are the largest firms out there now. They're one company. So there's a lot of acquisitions happening, and people always ask, well, what's actually happening out there? Are we actually dead? How does it affect a small company? Sometimes I do wish that HFT was kind of dead, because that would make hiring really easy for us, right? We could just hire the best talent out there, all the heads of HFT from all the companies. But unfortunately, that's not the case. What we actually see today is the hiring is more competitive than ever. They're being offered salaries that are, these people are making millions of dollars per year working at these firms right out of college. And some of these companies, they just got a new office. These are signs of growth rather than signs of failure. So we'll talk about that a little bit later. But anyway, I just wanted to basically, this part of the presentation is sharing with you kind of some of the changes that we've actually seen in the past, 5 or 6 years or so, from when we had started the company all the way until today. So there's been, even in the past 5 years, like a ton of different changes. So the first thing that I want to talk about is one of the challenges that we faced starting off, which was basically one of the challenges about high-frequency trading in general is that the data sets are very large, right? So we're dealing with potentially petabytes of data. Every day, let's say in the New York Stock Exchange alone, right, you get like over 300 million messages within just an hour. And 300 million messages here that, for a computer to process, it takes a lot of computing power. So you can't just fit that into the mainframe of a regular computer. You need some specialized hardware and software to kind of make that work. And so basically, in order to do that, in order to process data coming in so quickly, at a high speed, you need high-speed systems, and thus high-frequency trading is born. That's the whole thesis of kind of what we're doing is that in order to take advantage of all that data coming in every single day and to be able to trade it on a microscopic level, like let's say the data is coming in at nanosecond resolution here, and it's really, really fast. And in order to take advantage of all that data and not overlook some really important data points, you need to be fast. You need to be able to process that within the same hour, be able to generate some really good signals, and then be able to trade that really quickly. So that's why we exist, as a company. Now, when we were starting off, though, we had to create our data feed handlers, right? So we had to be able to basically, take all that data coming in and process that using our internal feed handlers. And so first, of course, what we do is, when you're starting off, you look online, you see what are the open source feed handlers that are out there? Can I use anything, or maybe go to another vendor and buy a feed handler from a vendor? Well, so 5 years ago, that wasn't quite possible because I think there were only 2 open source, fix engines out there that were available to us at the time. So we were pretty much, we didn't have an option. We were pretty much forced to create our entire technology stack internally in-house. So we had to hire a bunch of developers and create, our order management system, our feed handlers, all the major tools of a trading ecosystem back then. So today, we could do, I'll give you an example of how that's changed. The open source community has developed a lot in recent years, actually. So, we were able to hire, we had a bunch of interns. We work with these universities now, which has been really nice for us because of the open source community. We worked with MIT last year, and basically what happened was they asked us, hey, can we put some interns, into your company and they can work on some projects? The only constraint is, because these are current MIT, PhDs and master's students, they're not allowed to sign. You can't sign a non-compete. You can't sign an IP agreement. They whatever they use, they can just take to wherever they go next. And so that was a challenge for us because we couldn't share with them our code base. But what we could do with these students was we said, okay, well, why don't you go online, look at all the open source tools out there, and you can do a project where you detect, anomalies in market data. So what they would do is they would look for data. They basically parse data from like 14 different exchanges, and they would look for anomalies like spoofing or spamming or other sources of like market manipulation, and be able to write a strategy that kind of detects that within a shorter time frame. And so these students, obviously a lot of them, they have an academic background, so they've never seen an order book before in their lives. They don't have any, just like when I was starting, we had no experience. So they had absolutely no experience. And within 1 month, they were able to, they processed literally a terabyte of data on one laptop with 4 of them. And they were able to, from 13 different exchanges, all of this, a ton of data, and then be able to basically complete this project and search for all the anomalies that they were looking for using this open source, these open source tools that they had available to them. So, this would not have been possible like 4 or 5 years ago, but today, there's something that, because how fast the innovation is coming up, and, I guess the second photo I have is just some of the open source tools that we see online, so you guys can always look that up too. It's fascinating how quickly it's developed in recent years. So the other thing that we needed when we were starting up was data, obviously. So back then, we were looking around at, you look at the data vendors that are available. You go to like the FIA Expo and the trading show and all those other major expos out there, and you talk to all the vendors. And what we noticed was, the vendors would try and sell us, millisecond resolution, pretty lossy data, which in high frequency trading, we need data at least like 1 or 2 orders of magnitude greater, basically if it's microsecond or nanosecond resolution, that's great. And so the data wasn't that great, and it was actually really funny because that was the first time I felt like a celebrity, by the way, was I think we were at the FIA Expo when I think I just graduated from college actually, and a bunch of people, people were lining up to talk to me because they knew we were an HFT firm. We were like the ideal client base, for data. And it was funny because I was like, how did you hear about us? We literally had just started out of college, and yet, these data, there are more data vendors than high frequency trading firms, at that time at least. And so, anyway, that, so that was really frustrating for us. And then the other thing was that, we decided, okay, well, why don't we process the data internally and just grab data directly from the exchange because it's cheaper that way. So we just literally get data directly from the exchange, we process it ourselves, and then trade from that. And other companies then would start coming up to us being like, hi, can we buy your data from you? And that was also really bizarre because we had just started off to begin with. And so today it's completely different as well. The data now, you can get literally nanosecond resolution raw data from a lot of different vendors, and it's much higher quality than it used to be. So that's definitely one of the other changes we've seen is just the data has, because of the big data movement actually, back then, no one knew what big data was, and today it's a huge buzzword. Because of the interest and the new talent coming in and and also the open source and everything combined, there's a lot more competition, which means that the data coming in is a lot higher resolution and a lot higher quality than it used to be. Now, the other thing that was, that we've noticed was the kind of abundance of microwave towers that have popped up in recent years. So I was at a farm in Massachusetts, and I don't know how closely you can see in this photo. There's a microwave tower there. So you know how like normal people take photos of like, food and like shoes and I don't know, cars. I take photos of microwave towers whenever I see one. So there's you can barely see it. On the right side, there's like a little pixel on the cloud. On the back of the cloud, there's like a little pixel there. That's a microwave tower right there. It's really small, so you usually don't notice it unless you really look for it. But I was just at a random farm and I saw one. I was like, wow, because these things didn't exist like 10 years ago. So, over 10 years ago, actually, I think it was Goldman Sachs, and someone can correct me if I'm wrong. I think it was Goldman Sachs that they spent like millions of dollars building the fastest microwave routes between, New York and Chicago. It cost millions of dollars back then. Today, we're very lucky in that a lot of the fastest, not all the fastest routes, but many of the fastest routes out there are owned by vendors rather than by like by a Virtu or a Casey, by Citadel or whatever. So that's really good for small companies like us and for anyone kind of starting up, because all we need to do is we just pay a set fee, let's say, I don't know how much, $6,000, $10,000 a month, depending on which routes you're buying. And you can compete against some of the largest firms out there in terms of speed, right? And people never could have imagined that, you could do that. And so, so the stuff that they wrote in Flash Boys is a little bit, it's become a little bit more outdated in that, today, any small company can just go out there and just literally go to a vendor and just buy a fast route. So the other thing that people always talk about with us is, how fast are you? And also, when is it too fast, right? Like, have we reached zero yet? There's something people call the race to zero, where people try to, everyone's like, oh, you gotta be as fast as possible. Your latencies need to be zero, as the speed of light, in order to get maybe be 1 nanosecond faster. And so what we've noticed is that, at a certain point in time, it's just not worth it to be 1 nanosecond faster than your competitor. Now, I should probably clarify, actually, faster is always better in any industry. It doesn't matter almost in any industry. So in finance, that's AT&T's motto, right? Faster is better. So AT&T versus Verizon. If Verizon is a little bit faster, you can bet that a lot of people are going to move over to the faster carrier, right? There's the same thing for finance, actually. Faster, of course, if you get information at a faster rate, you can take advantage of that in certain ways that other competitors can't. But there's a limit to that in that, let's say if you have to spend an extra $1 million to be like a little fraction faster and you're not going to earn that money back, then obviously it's not worth it to be a little bit faster. And so for us, we realized our limit in terms of how fast is good, and then at one point does the marginal benefit kind of decrease, right? And that actually, the answer comes from the exchange. It doesn't come from us, because we could be as fast as we wanted to, and that's great. And other companies will race to try to beat us, but the limit here is on the exchange side, because the exchange's matching architecture hasn't changed at all, well, a little bit, but it hasn't changed nearly as much as it should in the last 5-6 years or so. So the graph right here is a latency histogram of, it's actually our trades during a day, on the green basically on this side. And then the other end of the histogram spectrum is the exchange's matching engine. And this is on a log scale, by the way. It's not a linear scale, it's a log scale. So you can imagine how much slower the exchange is compared to, basically the closer to the left you are, the faster you are. The closer to the right you are, it means you're extremely slow. So on the exchange side, they're extremely slow. When you send an order out to the exchange, there's a lot of jitter that happens. There's a lot of noise that happens, basically. And so, once it reaches the exchange is so slow that it doesn't even matter if you're a nanosecond faster, because there's so much variance also in terms of how fast your order actually gets matched. So there's a lot of, there's just a lot of jitter, a lot of variance. Keep in mind it's a log scale, so the tails of the the exchange side is really large, a lot of fat tails on that end too. So because of that, because of how slow the exchanges are, for us as a high frequency trading firm, it doesn't make sense to to spend all of our efforts trying to be a little bit faster than a competitor when it doesn't even matter, too much once your, trade actually hits the exchange. So I think our panel after this, we're going to discuss, talk about the big data, machine learning influence a little bit more, because those are big buzzwords today. I guess the one thing I wanted to just talk about right now is that machine learning's been around since the 19th century. It was called linear regression back then. Now it's called machine learning, which sounds cooler. Now, because of the big data influence, though, there's been a lot of improvements. So one thing that I guess would be interesting to talk about is also people using the cloud these days, right? Like AWS or other cloud providers. I think back when we were starting, we would talk to some people who'd be like, "Oh, we're a high frequency trading company, and we're in the cloud. We're completely in the cloud." And I'd be like, "No, you're not. You can't possibly be a high frequency trader in the cloud back then, because it's so slow. Everything is extremely slow in the cloud. You have to have proprietary servers and everything in the exchanges that are co-located. You can't just be in the cloud." But actually today, surprisingly, there's been a lot of innovation on the cloud side of things, and so today, if we were to start up again, we would actually seriously consider any implementations and use cases of actually being in the cloud. So that's something that we're definitely starting to look at. So then the other things are, back, I would say like 10, 20 years ago, when companies like Citadel started up and Virtu, they would basically focus on generalization rather than like specialization, right? So they would go out to all the different exchanges. They would try to trade as many different products as they could. It was really fascinating, basically, what they're trying to do, which is just pretty much everything under the sun. Today, as the industry is starting to mature, right, we're seeing companies acquiring each other. They're figuring out where to actually specialize in, rather than just trying to do everything at once, because people are starting to realize now, we can start to see who the winners are in our industry now. By the way, in cryptocurrencies, crypto was at that stage of HFT maybe 10 years ago, basically. So it's at an early stage where we don't know who the winners are, and I'm sure in the next couple of years we're going to start seeing mergers and acquisitions in crypto as well. And right now, a lot of hedge funds too, they're going to just try to trade everything they can, every product they can. So it's literally like, that's just the business cycle of any kind of innovative, technological trading that we see. So that's beginning to happen as well. In terms of cost, people will ask, well, isn't the barrier of entry really high in high frequency trading? And that is true. It is very, very high. But I'll tell you about some of the costs that have increased, and then also some costs that have decreased. So in terms of increased costs in recent years, one thing that has increased is like the cost of data, right? Like we're seeing, there's like Kensho you might have heard of, that was acquired by, I think, was it Goldman Sachs that acquired them? And then there's like Ravenpack. There's tons and tons of these data providers everywhere. And that actually drives the competition up, and it also means that there's a lot of different sources of data. So it's not necessarily that the cost has gone up, but rather that there's just so many different sources now. So like, if you don't know how to specialize as a startup fund, then you're screwed. Because there's literally people who are selling, they're selling satellite data now with parking lots, so you can see, how much business companies get. There's also satellites that look at oil rigs. I don't know if you've heard that story, where they look at how high the oil rigs are, and then during this certain part of the day, the sun casts a shadow, and based on the height of the oil rig, you can see how much oil is in that country. That's a huge. You can see the actual imports and exports before it actually gets reported. So there's all kinds of these crazy sources of data out there, and so it's just a matter of where you concentrate. I feel like it's similar to like airlines, for instance. Like, right, wasn't it like back in the 80s? I wasn't around back in the 80s, by the way. But I remember, people tell me back in the 80s, there was like, there's economy class and like first class maybe, and now there's, now when you're flying an airplane, if you're flying internationally, there's economy, there's premium economy, there's first class, business class, premium business class. There's like all these different classes. You got to pay a little bit more. And then if you want to be in group 1 boarding, you got to pay a little bit more to be in the faster boarding lane. That's kind of what it's like in data too. So like every couple of years, I think especially if you're in like the cash FX space, for instance, if you're in certain parts of the industry, you're trading certain things, every couple of years, these vendors, they're going to release like they're going to release a more granular source of data. So it'll be a little bit more granular than what they released in the past, and it's going to cost you a premium. And so if you're driven by an informational advantage, if you're a fund like us where we rely on information to succeed, faster data and things like that, and if all of our competitors are buying the more expensive feed, then it's like, oh crap, we have to buy it too. So it's just there's a lot of different ways to spend money on these different type classes of products. So we, unfortunately, we can't just stick with the economy class of data. We got to buy the premium, the first class data out there. In terms of things that are cheaper, you've probably already read it by now, but in terms of co-location, it is technically cheaper in a sense, by the way. The cost of co-location has always been around the same, I think, but what I mean by technically cheaper is that one server can now process a lot more than it used to. So we can literally take up like one little server space and process so much more data and computing power than it used to. So technically, in a sense, it has become a little bit cheaper. So anyway, I want to talk about the talent pool a little bit, which is a completely different topic, because I feel like in order to understand what's next in our industry, you have to understand the pipeline in terms of the future generation of the workforce in our space. So what we ended up doing, and we do this a lot, is we analyze job applications like all the time. So what we did here was we analyzed 20,000 quant research job applications for our quant research role. This is literally one job position here over the course of, I believe it's over the course of 1 or 1.5 years or so. And so we'll see. Let's look at some of the results, basically, of what happened. So we look at things like keywords, right? On things like this one is on MOOCs, by the way. So you guys know, have you heard of Coursera or Khan Academy? Some of those other things where we're taking a class online and you get a certificate by the end of the class. So those rose in popularity and then quickly declined in popularity in recent years. I don't know why, but it's just something interesting that for us, we were like, wow, I guess turns out the Harvard degree does maybe have a little bit more value than taking a class on the internet these days. So we're looking at that, and then we've seen, there's buzzwords, right? Like, so obviously big data, data science, artificial intelligence, those terms are on an uptrend. They've been, they're continuing to be, it's the popular thing that people want to do. And so we're definitely seeing more and more of that in recent times. Let me see, what else is there? We also looked at machine learning, data science, and statistics. And we see a lot of, everyone studying machine learning and statistics. Data science, not as much in our space. You may see more data scientists working for like Microsoft Labs, for Intel, for IBM, but not necessarily for our industry, because the traditional machine learning techniques that a data scientist might use may not be applicable to high-frequency trading, actually. And it's a completely different talk, but I'm happy to talk about that if you guys have any questions afterwards. So the next thing I want to talk about really fast before I end is just the effects on high-frequency trading startups. Like, how are we affected by all this stuff that we just talked about here? So the first thing is that back then, we were kind of forced to build everything ourselves, which is great for us because now we have a ton of IP and we can kind of license that out to different companies. And so that's nice. At the same time, it was also very expensive, very time-consuming. And to be honest, I was living in hell. I mean, it was like, we had to raise, and I'll talk about this during the panel as well, but we did something really weird, which was we raised venture capital. As well as, so we raised literally a GP round, and then we raised an LP round for the actual clients of the fund. And that back then, I think that was unheard of. Like, no one does that. But we had to because, we were a technology firm on the inside, and then on a business level, we were a hedge fund. So today, it doesn't make any sense to reinvent the wheel, right? When there's so many different great tools that are available in the community out there. So yeah, that's definitely one thing that would change is we would probably buy versus like building. The other thing is like, especially, I would say, talking about like some of the older companies in our firm, some of the legacy competitors in our industry, they would have literally 60 developers working on like just to support like a team of one little team of traders basically. So the emphasis back then was on hiring a bunch of good devs to kind of create and build those tools. While today, because you can outsource, because you can pay a handful of other devs to do it, you don't actually need to hire so many people. And so right now, internally, what we're doing at Domeyard is we're starting to increase the ratio of researchers to developers so that hopefully one day it'll be maybe a 2-to-1 ratio versus right now it's about a 1-to-1 ratio of researchers and developers. So the other thing is the industry is evolving, so costs are becoming fairer. There's a lot more transparency, there's a lot more accessibility in our space than there used to be, than ever before actually. Instead of focusing on how to differentiate ourselves on an infrastructure level, so like instead of playing the race to zero, buying all the servers and playing that hardware game that some companies still do today, a lot of companies are starting to focus on research and business differentiation. So how can we differ ourselves in the research pipeline? How can we do more innovative strategies rather than just being blunt force faster than everybody else, right? So those are things that we start to think about. And then a couple of other things that I think we'll start to see in the next couple of years are things like better tools that'll speed up the research pipeline. Because right now the research pipeline is largely you hire someone who has maybe a PhD, and they'll spend a lot of time. It's almost like running a research lab, which is not a good thing, by the way. But they'll take some time to kind of come up with these ideas. But if there were some tools to kind of automate that process, I think that'd be really, really interesting to see. So I think we'll start to see more of those in the next couple of years or so. And then also a lot of the innovations we've seen in high-frequency trading are starting to trickle into the rest of the industry, actually. So I used to work on a discretionary trading desk. Even the discretionary traders that I used to work with, they're starting to use some of those tools, like the data analysis tools where you don't have to know how to code. All you need to do is just use the software, open it, and run an analysis. So they're starting to use a lot of those tools that I'm like, hey, I use that in high frequency trading, and now they're starting to use that today. So I think that's really cool how even the most discretionary traders are starting to adapt some of these technologies into their practice. So I think that's it for my presentation. Thank you so much for doing this. It's a huge privilege to be here. I will be here for the rest of the day, so you're welcome if you have any questions to come talk to me. You can also reach out to me through LinkedIn if you guys want to chat further about this. So thank you guys so much. It's a privilege to be here.